Welcome to this explainer. Look, if you're running an e-commerce business in a specialized industry, you already know that keeping your merchant account active is your absolute lifeline. So today, we're going to dive deep into exactly how Visa judges your chargebacks, and more importantly, how you can survive and actually thrive under their strict new rules.
Here is what we're tackling today. The high-risk reality, refunds versus chargebacks, the 5-step dispute process, Visa's specific rules, and finally, prevention and adaptive payments. Let's get right into it. Section 1. The high-risk reality. We're navigating a multi-billion-dollar problem here. To really grasp Visa's strict rules, you have to look at the staggering scale of the threat. $40 billion. That's how much is lost every single year to fraud and chargebacks. I mean, that massive financial bleed is exactly why card networks like Visa are cracking down so aggressively. They simply can't afford to have high-risk thresholds anymore, so all that pressure gets passed directly down to you, the merchant. So who feels that pressure the most? Well, if you operate in specialized industries, we're talking travel, telehealth, CBD, supplements, or gaming, high refund rates and customer disputes aren't just a possibility, they're a daily operational reality. Visa considers these high risk for a reason, and if your business falls into one of these categories, you are squarely in their crosshairs. Moving to Section 2, refunds versus chargebacks. Honestly, knowing the difference here can literally save your business.
The contrast between these two is stark. Think of a refund as a friendly interaction. You initiate it, it's cheaper, it's faster, and it actually builds trust with your customers. A chargeback, on the other hand, is a hostile, bank-initiated penalty. It severely erodes trust, brings high fees, and paints a massive target on your back with Visa.
Okay, Section 3, the 5-step dispute process. Let's take a look inside the Visa Claims Resolution, or VCR system. It starts off simply enough. Step 1, a customer disputes a transaction. Then, Step 2, it enters Visa's system. Now, if you decide to fight it, we hit Step 3, representment. This is where you provide your evidence. If that fails, it moves to Step 4, pre-arbitration. And finally, Step 5, arbitration. Notice how, as a dispute climbs this ladder, the burden of proof and the financial stakes increase dramatically at every single stage. If you are forced to fight disputes in that final arbitration stage, the sheer costs can absolutely crush your business. We're talking heavy administrative costs, escalated network penalties, and a very real risk of complete account termination. Because the expense is so incredibly high at this point, many merchants are practically forced to settle before it even gets here. Which brings us to Section 4, Understanding Visa's Rules. Let's talk about the VAMP rollout and accepted reason codes. Visa meticulously categorizes every single dispute into one of 4 buckets. You've got the 10.x codes for fraud, 11.x for authorization glitches, 12.x for processing errors, and 13.x for consumer disputes. Here's the kicker. To win during that representment phase we just talked about, your documentation must perfectly match the specific reason code Visa assigned. You simply can't fight a consumer dispute using evidence meant for a fraud claim.
And all of those codes feed directly into this vital metric, your VAMP ratio. The Visa Acquirer Monitoring Program calculation evaluates the volume of chargebacks and fraud strictly on monthly ratios, not raw numbers. This ratio is basically the heartbeat of your compliance. If Visa categorizes your ratio as excessive instead of above standard, your penalty charges are going to absolutely skyrocket.
Finally, Section 5, Prevention and Adaptive Payments. Let's talk about building an active shield for your revenue.
The foundation of this shield starts with you. You need a clear, streamlined refund policy, and you've got to display it explicitly before checkout. Combine that with consistent customer service and closely monitoring those VAMP ratios daily or weekly. Just being transparent can stop a simple misunderstanding from turning into a nasty 13.x consumer dispute. But remember, don't make your policies so loose that you end up attracting fraudsters.
But let's be real. Human effort alone isn't going to cut it. You need high-level technology. Since fraud and chargebacks go hand in hand, partnering with a specialized processor like Adaptiv Payments equips you with an entire arsenal of high-tech prevention tools. We're talking real-time transaction monitoring, machine learning pattern analysis, address verification, device fingerprinting, and IP analysis, the whole shebang to stop bad transactions before they happen. There's a great line from the source material that sums this up perfectly. Quote, "Our recommendation at Adaptiv Payments is to keep an even closer eye on your chargeback ratios than Visa does.
You should aim to have as few chargebacks as possible. You literally cannot afford to be passive in a high-risk industry. You have to monitor your metrics obsessively to secure your long-term growth and stay completely off Visa's radar.
So I'll leave you with this thought to chew on for your own operations. Is your current payment processor proactively protecting your growth, or are they quietly putting it at risk? Because in the complex world of high-risk e-commerce, having the right partner isn't just a nice-to-have, it's an absolute necessity. Take a hard look at your systems, ask yourself if you're truly ready for the VAMP rollout, and take action. Thanks for joining me on this explainer. Protect your revenue, and I'll catch you next time.